Hello, everybody. Maybe that's a better angle than last week. My name is Daniel Young. I'm the owner and founder of Adaptive Perspective and the Adaptive Perspective social media platforms. And I am back to talk about our stock market strategy as well as give you just an overall update of what I see happening in the financial world. So, the normal reminders this is an unedited video. Who knows what you'll hear in the background as I film these in my house. I'm not a financial advisor, I am a financial strategist, and I don't talk like the herd. Um, and I walk in limited company, and sometimes I walk alone. So, I'll, the general update on my end of things, still slogging through the book. I'm about, I think I'm 18 chapters in, about halfway through the overall 12 steps. I've got, we'll say it's intro and background in like a mindset orientation, and then the 12 steps. So I'm about halfway through the 12 steps. It was an interesting week, 4 day week on the school side of things. So shorter time in general to work during the week and just a busier week. Um, but I'm slugging through that and just looking forward to finish that. On the market end of things, I want to talk about, quite honestly, the long version of things. I've gotten into a habit of running through my dialogue through ChatGPT, and it gives me this nice consolidated list that I send out by email. Uh, if you, for whatever reason, you want to join that list, by all means, uh, let's see. If you want to leave, I don't know how to get me that info because I don't want you to list your email on Google. Um, we'll troubleshoot that in the future. How about that? Uh, I don't know. The other way you can try to find me on Substack and drop me a comment there. Same handle, same name, just at Adaptive Perspective on Substack. There's no content there because I made the page and went, I should probably write the book before I make the page. So, hindsight. Uh, but maybe that's a much safer platform to list your email on than Google or on a YouTube. But so I put my entire dialogue into chat, and then it helps organize my ideas, and then it'll also filter that down into an email that's not just this long drawn out thing. So I did the same thing today, and it did consolidate things to a degree, but it also trimmed out a lot of the info. And I don't want to seem like I'm hiding info from you, even though you never would have known it was there. But at the same time, I feel like I'm not telling you the whole story. So I'm going to give you the entire rundown, and then we'll look at the funds. So I want to start by coining a term that you're not going to hear anywhere else: ghost unemployment. And what I mean is this: ICE is reporting that 3.1 billion people of the roughly 30 million known illegal immigrants have either been deported or self deported. And personally, I think that 30 million number is on the low end of things because that's what they know. But regardless, 3.1 of the 30 million known illegals have exited the US workforce. And if that had been American workers, we'd see 3.1 billion new jobs among the, or say 3 million new job openings. Uh, whether we saw a specific correlation between unemployment or not, who knows? But we'd have 3.1 million job openings. But these are all undocumented workers, illegals. They get paid under the table, and those jobs don't officially exist. So they'll never appear in the Labor Department's unemployment data. Add to that the federal firings, both before and during the shutdown. Currently, 4,000 federal employees were fired, and the vast majority are not going to get rehired. And the shutdown is allowing both a reason and excuse to fire the government bloat. And the number is small, I get it, but it's also symbolic because the bloat overall is being trimmed. I think that's a good thing for us overall. I think that's a great thing for the country because it's less money that you and I are paying for government bloat. But again, that 4 grand or that 4,000 is not going to meaningfully change the official jobs data. Now, true, More people are taking severance packages. They're self-deporting from their jobs, but we don't have that data yet. And now there's AI. AI is not getting people fired. It's getting people not hired. You have smaller and mid-sized businesses leaning into AI and improving their overall efficiency, improving their cost. That's a good thing. They're using it to cut expenses. Big corporations like Meta aren't adding new hires. They're keeping the current ones and raising their pay, which that sounds great. But AI isn't stealing the jobs. It's just making certain positions obsolete. And if you put all of those things together, you get ghost unemployment. So jobs vanish without ever being counted. And they're invisible because they're coming from deportation, so jobs that never technically existed, government downsizing, and then overall AI efficiency. Now, if the jobs were legitimate, the workers leaving would create openings for displaced federal employees or the tech impacted workers from those small and mid sized companies, but they're not. They never actually hit the ledger. They never hit the checkbook because it's all under the table money. So the system doesn't record them being in existence. And we end up with hidden unemployment pressure that never appears in the data. And that's if you fully trust the data. And I don't trust the data because it's averaged. And it's not because of which president is in office, it's just the Labor Department in general. I don't trust the data because it's averaged data that includes the highs and lows of seasonal workers around the holidays. It's average data that just kind of gets blended into the other data. Really don't know how much they skew the data. So it's always questionable. All right. So if we go from ghost unemployment to GDP, if unemployment were truly rising, GDP growth would slow, but that's not happening. GDP continues to climb, and that's driven by ongoing investments ongoing investments into the United States. We have more and more companies building U.S. based manufacturing, right? That's great for local labor. It's also great for the overall economy. We have foreign developers pumping money into the U.S., which is great for the U.S. economy, great for the GDP, great for local economies. You also have tariff revenues, and then you have a strong consumer sentiment. And recent polls show that most Americans, believe the US economy is headed in the right direction. And the optimism matters. Regardless of what you think, overall optimism matters because people spend more when they feel confident. This week, mortgage rates ticked down. Now they're still high at 6.4, but they're moving in the right direction despite the Fed's lack of ability or despite the Fed's slow motion rate cuts. And with the former labor secretary ousted for falsifying data, federal employees accepting severance, right? 4,000, and I think it's going to be more than 4,000 federal employees out the door, and GDP climbing, the Fed has every excuse to drag its feet. But we're well past the point of excuses. We need action. It's time to cut rates. Cutting rates helps you and me. Cutting rates also helps the Treasury Department. And I've been saying for months, the Treasury Department has to refinance $9 trillion in debt. You think about refinancing your house, right? And refinancing your house at, like, we were fortunate to refinance our house when rates were below 3%, right? But now think of refinancing $9 trillion at rates above 6%. That's a significant difference in interest payments, money we could save to use to pay down the debt and a lot of other things for that matter. But the Fed's dragging its feet. So it's almost like, where do we go? Oil and natural gas, I think, remain key. More oil means lower inflation. Tax cuts help with inflation. If the Fed did its job, lower rates would help with that as well. More natural gas means less strain on water utilities, more efficient cooling for data centers. If you look at where AI is and where it's going, a lot of AI. I don't want to keep saying AI outright, but a lot of companies who have a ton of servers, AI and other, they're using natural gas to cool those instead of water. Water's expensive. Natural gas is cheap, and there's a ton of it. So less strain on water utility, I think, is a good thing for you and me. Should help our pricing. So if we free up overall supply for us, right, then it's beneficial for everybody. Data centers get cooled more efficiently. We get more water. We pay less for it. What else? We've hit ghost unemployment. We've hit overall GDP and sentiment. We've hit the Treasury Department. We've hit inflation and energy. Let's look at the economy overall. The US economy overall is a lot stronger than anybody on TV outside of Scott Bessent, right? Or really all those different department chairs under President Trump, or committee chairs, or secretaries, however you want to say it. The US economy is a lot stronger than any pundit or political analyst or reporter on TV will ever admit. Investment continues to pour in. Foreign markets, not my focus. The real strength is at home with everyone wanting to be in on the US economy, where 40% of the world trade happens in the US, and with money pouring into the US, investing outside the US right now doesn't make much sense unless you got just a stellar deal. It's kind of that thing where if everybody's focused here, right, and that other pricing starts to suffer and drop, you're just you're going to the next party super early. You're everybody. It's what I say about everything else. Like if you can find that dogged corner of the market that's just super cheap because nobody wants in on it, then buy the deal while it lasts. And even though you're way off in left field, you're not with the herd. You're walking alone. So long as you're comfortable with it, and you're like, it's gonna. And I would agree with you. It's all cyclical in nature. Right now, we're on the forefront of everything. So I think so. Price it. Lots of thoughts at once. We're on the ramp up. If we were at the top of the wave, I'd probably give you different advice. Like if you got into the market, be careful because pricing is high. Versus we're at the that intro slope, like right off ground level. So it looks like fast paced, that fear of missing out. You still don't want to be steered by emotion. So you're still looking for a deal. But with everybody looking at US market, if you find it just a dog corner of the market in foreign market, pending country, that could be a really good deal and you would be ahead of the cycle. So you'd have amazing long-term vision where everybody else missed the buck and you would be to the party crazy early, right? So you would deal with low pricing, but in the closed end fund of the world, you'd be getting a stellar dividend. So if you're comfortable being on your own, then by all means, be comfortable on your own. Uh, let's see. So really, say the last two things maybe before targets and before we get into the full list. With the current market and the shutdown, and not, I mean, I've been political as it is, not trying to be political in this. During shutdowns, the market is bumpy. Post shutdown, for the most part, on a wide scale, you never even know what happens, right? It's the economy and the market overall keeps moving. It might stumble a little bit, but it's not going to stop. So the herd, for whatever reason, seems to be more jittery than normal. We saw that at the end of the week last week where the market dipped. And I think it's two things. Maybe it's three. No, maybe it's more. It's you have the herd's general uneducation or lack of education on the market. They're relying on their news jockey people, their teleprompter jockeys to tell them what to do. And all they hear is fear, fear, fear. So you have the herd's own lack of knowledge that's hurting their growth. They're getting told to be fearful of all this stuff. And there is this just general, palpable uncertainty about how long the shutdown is going to go on. Overall market sentiment, overall economy sentiment is high. And the herd is boosting that number too. But currently, the herd is running scared and they're jittery. It's like your animals dealing with fireworks, right? You hear one and you're kind of freaked out. You hear more, especially those black cats that all the kids love, where it's like 50 in a row or 1,000 in a row. You hear one and you're scared. You hear a 50 or 1,000 in a row, you just get really jittery. And then that overall anticipation just kind of holds weight. It's like its own smokescreen. So, despite overall sentiment being high, current confidence is low. So, volatility is ticking up, not because anything has changed. I mean, quite honestly, yes, the shutdown, you've got the underlying drama, but it's the herd. It's their inability to separate political noise and the TV nonsense from the economic reality. And at the result, yeah, the market dipped a little bit. But when we step back, I don't think we're going to see the blip. April, we saw the blip, right? With the tariff reset and all that. That will appear on everybody's data for a while until maybe a decade from now. It'll just blend in with every other blip in the market. But in general, even though I disagree with the existing fear regarding the shutdown and whatever else is out there, that doesn't mean the herd is going to agree with that. But that's okay because when the herd's fearful, that's a great time to buy. So my advice would be buy the dip. It's not a dip in the sense like it's not the tariff dip or this dip or that dip. It's just the shutdown dip because of the herd. It doesn't really matter. Buy the dip. As for what we're buying or what we would buy, we just bought, which is kind of frustrating. I mean, there's no way to time the market in that regard. Uh, yeah, what if this? What if that? Never works. Uh, so yeah, we bought, and by the end of the week, the market blipped, but that's okay because it'll come back. No fear there. So more of a what could we buy or what should we buy or could we use the dip to our advantage is kind of my thinking right now. And we have some options. So the strategy right now is still the same thing. It's still bonds and bonds proxies. And it's still energy and energy transfer, and it's still US talks with an AI integrated play, which would be both those powerhouse blue chip options as well as just small to mid grade companies. So let's see how to say this. AI AI is a tool. It's not everything. And depending on a company's individual awareness or individual reliance upon AI and how they integrate it into their systems, everyone should benefit from AI, but not everyone will. Those blue chip companies, Meta, Microsoft, Apple, those guys are going to get the headlines. The small and mid cap, like mid tier, like still a still something more than a one person company, right? But like 5 employees to 500 employees, that's not Meta. So you've got small and mid cap companies. You're going to see a ton of growth because they're relying on it and integrating it and cutting cost and pushing that back into the business and helping the local economy. You'll see growth there. You'll see some growth in that really large cap group. large company size group, but not as much as a mid-level company. And my advice all along is if you buy those single companies, buying them all is hard and it's expensive, right? And hitting all of those in one shot is near impossible. But that's where closed-end funds come in. That's where they factor into the strategy because they make the diversification process easy. They make it a lot more manageable and honestly a lot cheaper. And that's not to be, I mean, I've harped on diversification in the past. I am not a diversification for diversification's sake. It's it's like I'm not adding stuff to my portfolio simply to have it diversified. Makes no sense to me. Buy the deal, long-term plan, get a fat dividend, see growth, right? All of that factored in the strategy. Just buying it just because just doesn't work for me. But diversification, inbuilt diversification into all these different sectors gets a lot easier with closed-end funds, and especially if you follow my system. Stick to the rules, filter out the noise, use your short-term and long-term targets, and the strategy works. And the longer you do it, the easier it gets. So if we look back at our targets, if we look at bond and bond proxies, so bond proxies, municipal bonds, um, let's see, bonds and bonds, municipal bonds, utility districts, real estate, oil to a degree, even though I think oil is its own category. Uh, all of those are tied to bond rates. Energy, which would still be oil and natural gas, and still end up with utility districts and stuff like that. But then energy transfer, that helps both oil and natural gas and water. And then you get US tech stocks and that AI integrated play. And all together, those are the things we're targeting. So if we look at the master portfolio and then the filtered down list for the week, let's see how to share my screen. I didn't pre-filter it this week. I wanted to filter it with you, but I did sort it. So my focus is always monthly, unless there are good things to be found in the quarterly payers. And there are some good options. On my end of things, I don't want to add anything to my portfolio unless it gives me a different angle than what I already have. Simply layering funds that do the same thing, completely pointless to me. That's diversification for diversification's sake. I'm invested in all these different funds, but they all do the same thing. That's not really helpful. So we'll start at the bottom. USA and ASG are powerhouse blue chip funds. They are different portfolios. They're sister funds. Uh, USA's got a commitment to pay, I think, 10% out through dividends for the year. So like 2.5 a quarter. ASG has an 8% rule, so 2% a quarter. That being said, the dividends vary. Uh, they're typically not on this big of a discount, but they are. Partially from the dip, partially for reasons I still can't explain. But that being said, I think they're more short-term plays in the sense of if you look at their pricing history, they never really get higher than $8 to $10, pending like either company. And it's a very cyclical thing. I think part of that is just the structure of the economy and what happens at the time. I also think it's how they're set up. It's like a multi-managerial schedule, like different people doing different stuff versus ADX is really just one management fund managing the entire fund. And then they have an 8% payout commitment for the year. But at the same time, I'm still hoping they pay that special dividend in December. It used to be 5 cents a quarter, which looked like nothing. And then they paid this really fat dividend in December. So far, the last three payments, they increased the overall dividend a share. It looks like they're spreading it out for the year, that 8% goal to spread out dividends for the year. But I'm also hoping they pay an extra special dividend in December. We'll see. Maybe, maybe not. So on my end of things, so we own ASG, we own USA, 200 shares of both, I believe. Uh, on my end of things, they make great short-term plays. It's an investment into the US, but short-term meaning like you could set a price point on it when they hit this price point, I would sell it. Or on my end of things, I think what I would go with is if they hit that 20, they hit a 20% increase, 25 or like 20% threshold. So maybe 5% growth, 15% dividend, or 5% dividend, 15% growth, whichever it is. If it's 20% or above, it's probably worth selling it and moving on to something else. The price point, ASG is like the highest it's been. It's probably 9 to 10, and USA is probably the same. But traditionally, they sit around $6.50. So that's different than ADX. ADX, you get the dividend in the notes. You can, I'll put these up. You can pause the video and read the notes. So USA, this is ASG. Same thing. Pause the video, read the notes. Both funds have paid out the majority of their growth in dividends. That's great. But if we look at the overall pricing history and then zoom out the chart from the time they were founded, ASG and USA do this. ADX does this. So you get dividends and growth. And ADX is also point to point or end to end energy. You can buy, like part of their portfolio is renewable energy or just natural resources, to where you get the creation, so drilling, pumping, producing, transporting, like every point of the way, end to end energy, plus it's powerhouse blue chips. And it's all three of these funds are just targeted in the sense it's not 600 different funds. Like ADX is less than 100, USA I think is 130, ASG is about the same. So it's very focused investments and not just spread out for the fun of it. So those three would stay. Aberdeen, I'm not an Aberdeen fan. I've said that plenty of times in previous videos. DX. Oh, it is. Same thing. You can pause that video or pause the video and read that. It if your play is volatility, then selling covered calls sounds like a decent strategy. Like these others, it pays quarterly. So I mean, it pays decently. 8% is decent. Um, and I honestly haven't looked at its track record to see its average price. So I couldn't tell you if it's a great deal right now or not based on price, but I do know it's a great deal based on discount. Gabelli is a well-known name, and you're buying the fund, but you're really buying the name. Um, it's it's a smaller portfolio, but it's also a well-built portfolio. On my end of things, it's more portfolio when it can than I would like. Um, all right, let's see. The CLO market space right now, the collateralized loan obligation marketplace right now is not a place I want to be in. I'm all for buying when people are scared, but that's like it's just a more jittery cricket. Um, if the herd is jittery right now, the CLO market it's like a meth addict. I mean, they are running helter skelter. I'm happy to hold on to OXLC, even though they had the reverse buyback, even though our shares got cut. Dividend may or may not, it actually might come out ahead on the dividend. We'll see on the next dividend payment. But I'm not willing to buy more. Honestly, when it was like 345 and so under NAV, it was just a steal. That was a great deal. Currently, with the buyback, they jack the price or the reverse buyback, and then they increase the price. It's really hard to know if it's a great deal or not because there's no data on. I mean, like 1645, it's low. It came onto the reverse buyback at 20. So yeah, it's not a great deal. It's cheap, but the market itself is so jittery. It doesn't inspire confidence. Like I'm happy to buy when people are fearful to get a great deal, but it's so sketchy right now. It's not where I want to be. Let's see what else we can cut out. Oops. So here, we can get rid of these. If I did these videos live, y'all could tell me what I'm missing. All right. Let's see. NBXG for a straight up text made it 15 bucks. It's expensive, but it's not as expensive as what it's been. It was climbing almost to 16 recently. So getting it $1 off of that price point is a deal. For us, it's interesting and it would be an option. I just don't know if there's a better option. So I'll leave it on the list for now. DX is interesting in the sense it gives us something we don't have, but I don't think it's the best place for us to be. So by comparison, if I'm unwilling to pay 14.46 for DX, I would be unwilling to pay NBXG at 15. But we'll leave them both for now. RLTY gives us another way to buy cone and steers North America, essentially, uh, at a discount. We own RFI, which is a predominantly North American based real estate fund. RLTY is almost the same portfolio, slightly different weights to the funds or to the stocks they own, but it's pretty much the same thing, which doesn't really like that's the diversification for diversification's sake. We own a Cohen and Steers. We could own this one. It would give us a way to buy real estate with Cohen and Steers on a discount, but it's 15 bucks. And I would much rather just track RFI, which fluctuates somewhere between 10 and 12, and buy RFI when it's on discount. I don't want to just buy it I don't want to buy it simply because I want to buy real estate on a discount. I can wait. Double line or DLY does do something different than DSL. We own DSL. I've not bought DLY. Um, it's a very different portfolio than DSL, which I like. Um, I mean, like ASG and USA, they sister funds, but they do things differently. DLY and DSL, sister funds, but they do things differently. So I think that's a decent option. I don't know if it's the best option for us, simply because, and yes, DX is the same way. We don't already own it. Buying it on a dip doesn't really impact our current overall share average. So it might not be the best thing for us, but we'll at least leave it on the list for now. Eaton Group, I mean, I've seen articles on the Eaton Group recently, but I've said this on previous video. Two things. So if you buy a dip, like across the board, so the market dropped about 2%, 2.5% across the board. So if you buy anything without like without any kind of strategy, if you just bought anything, you would probably come out ahead because the market's going to respond. It dropped about 2.5% because the herd's jittery. At some point, it's going to bump back up because that's what the market does. So after a dip, you're almost insured that whatever you buy is going to rise again. And I understand how shady that sounds, but I'm stepping back and just looking at the giant overall picture. So anything you buy has a super high potential of rebounding and getting you more money, right? Or recouping your money to where you could sell it at a higher value. I've seen Eaton Vance groups. I've looked at their portfolios. I've compared their portfolios. They're well-built portfolios. They're structurally different than ADX, ASG, and USA in the sense that they're invested into 500 plus different funds. On their end of things, they're well diversified. So that on their overall risk, like they have 500 funds at whatever, however many million dollars invested. But if their highest, like if Sherwin Williams is only 1% of their portfolio and it's spread out into all these other funds, feeling the bump if in the chemical market isn't really going to drag your portfolio because it's only 1% invested into that versus ADX is targetedly invested into AI rich large cap stocks plus some other stuff. So if AI has a blip, you're going to feel that more because that's where the bulk of your fund is invested. So I get the spreading out of your funds. That being said, it's not my style. I like pointed, targeted investments. And if you know what you want to pursue, then just go after it. Don't just spread it out for the hell of it. So Eden has been on my wish list for a while, but I started looking at their stuff and just realized it, not that it's not a good fund, it's just not my style. They pay well, they're built well, just not me. BlackRock, I'm not going to buy BlackRock. Anything BlackRock, I don't want. River North, I've seen some interesting stuff about. It's just not tempting for me. What's probably going to make this easier is if I actually do my system. So normally I rank by target, then I go by pay schedule, and I trim out the stuff that doesn't really anything that's not monthly that doesn't make sense. Which right now there's just more. There's four or five funds that make sense based on the given market, and then I look at yield, and yield's the big thing. So if I'm going to buy a fund, I want to buy something that's 9% or better in a dividend, unless there's a good reason for keeping it. And when HFRO was sub six and had this 60% discount, that's just hard to look past. Currently, I mean, their price has gone up. That's great. Their discount has narrowed. That's great. That's good for me and our overall portfolio value. But they haven't raised their dividend yet, which I would like to see that raise. 650 is still a great deal. Let's see. And this is our portfolio. HFRO, that's our current buy-in price. 650 would be the highest buy-in. Yes, it would raise our average, but on the big scheme of things, it would not be a significant dent. But at the same time, is it the best thing we can buy right now? It would probably make the list because of the discount, but the dividend, right? Because since the dividend stayed the same and the price has gone up, the yield has gone down. So if I really want to get picky about following my own rules, so the standards would be triple asterisk, significant discount, pay scale, primarily monthly or priority monthly, unless there's a good reason for keeping something else. And then we look at the yield, right? 9% or better. And then we screen the list based on targets. So if I'm hyper focused on my standards, HFRO doesn't make it. NBXG, for being a 5G focused company, doesn't make it. ADX doesn't make it, but I think they would be an exception just based on their portfolio. It's how the portfolio is built, the fluctuating dividend, and we'll see if they pay that. If they pay the special dividend at the end of the year, it's going to throw that number off. But we also look at dividend history. It's they pay out dividends and they also grow the fund. I think that all of that together, it's hard to look past. KYN is a great value for the moment. I think it's a great short-term play because the energy market is very cyclical. But as a pipeline company and a toll bridge company, yeah, the normal is that I need to update my list. I really do. I do the monthly update, but I really need to deep dive and go back in and really update my my sector information. I also realized I need to update this overall uh, list of notes, which I take notes on about every company I find. And all of these companies, I mean, they're great, but I also need to update the notes section. That's a job for another day. Let's see this one. So I think ADX stays, even though it's not a flat out 9%. KYN a um, as a toll road company or toll bridge company and a pipeline company that's going to be huge on manufacture infrastructure and routing uh, both natural gas and oil. I th- and I get that it's a sub nine dividend, but you're buying something ahead of the herd, realizing it needs to have right. All these AI data centers are going to, or all these AI centers, data centers, and cooling plants are going to pop up because one chat GPT conversation requires so much more energy than a simple Google search. It, it's insane how much energy we're going to have in order to just fuel AI. So to buy the pipeline, sorry, cat passed my window on the outside. Um, Not my cat. We have like a wildlife corridor right outside our front window. Um, you buying a pipeline company now, even though the dividend doesn't match the standard, you're buying something before it's popular. That's worthy of staying on the list. Let's see. DX for the volatility play. NML is like KYN, slightly different portfolio setup, but still a decent idea. ASG we've talked about. DLY starts the 9% club. CIF is a bond portfolio that tracks rates and it's cyclical or it follows the wave of interest rates. So if rates drop, the portfolio value should go up. I bought it inside my Roth. I did not buy it inside the brokerage fund. I found that I will ride the wave, but it's not my favorite thing to do. HGLB is trending so opposite of how I thought it would. I'm not. I mean, it's yeah, it's weighted in these fat. I'm not going to read that to you. It's weighted in that fashion, but at the same time, they've got a 30% investment into a mid-wave wireless company that's kind of like they've got both a corner on the market, but at the same time, mid-wave hasn't been highly sought after, and that might be changing. So I was uncertain about what to do portfolio wise on HGLB. Uh, yeah, woulda, could have. Yeah, we should have bought it lower, but at the same time, we didn't. So I don't know how long I'm going to hold on to it. Like, so long as it keeps going up, sure, by all means. I don't know. I need to learn more about mid-wave wireless companies. Um, but at the current price point, like at $3 higher than where we bought it, that's not high on my list. Um, Portfolio in a can is not my style. USA, I've talked about 50-50 stocks to bonds, 50-50 US to foreign, right? So my focus is on the US. FCO, I think, is built for the existing economy and the coming economy. It's a small, it's a BDC cloaked as a bond company. Um, and I think they're just well positioned. Eagle Point is a CLO fund. River is mixed. I still hear mixed things about it, but on my end of things, it's two portfolio in a can. BRW might be the best thing for me right now. BRW is selling a 1 to 3. It's selling rights like a 3 to 1 right now. For every 3 shares you own, you have a right to buy another share of common stock if you so want it at a reduced price. And I want to say that reduced price is $7.21, which is quite different than this number. And I wish I had seen that prospectus last week. They've known they were doing this for a while, I just got the prospectus Thursday and Friday. It would have been great to know last week because I would have held off on buying another 200 shares of BRW. But so be it. And then let's see, Hicks overall just does not outpace the market. So it looks great, but it's not. So that leaves us with this, which is going to seem really wishy-washy. And I don't like being wishy-washy. I like targeted stuff. So we just bought. So we bought BRW, FCO, and KYN. And I held off on this stuff. Um, I focused on bonds and BDC and then pipeline. So it's 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 threefold. It's the market dipped, so it sounds like a great opportunity. It's I need to figure out what exactly the rights offering that BRW is offering. Sounds redundant. So I got to call my brokerage house and figure that out and see how that's going to go down. And then there's the overall fear of missing out because it dipped. It sounds like a great time to buy, but you can't buy everything. So it becomes what's the best thing for you? So you don't have all the money in the world. You you can't buy everything. So the best thing for me might not be the best thing for you. BRW seems like the best thing for me, along with FCO, just based on price. And I get it. USA has a cheaper price. My hold off on buying USA right now is I'm not going to see a dividend until January. I like to time my quarterly buys well. And we bought USA and ASG last month because they were on great deals. And I didn't realize that the ex dividend date had already passed, which is frustrating. So then it's well, do we sell it or do we just hold on to it and see what happens? And I think we're at the point of holding on to it and seeing what happens because I think investment into the US in general is a great idea right now. Long term, based on their charts, is doesn't seem like a good idea to me because just based on their price charts. So on a short term side of things, we'll see how that plays out. On a short term side of things, maybe that's worth investing more into it. But I like long-term stuff. I want to I want to buy deals in the current market with a long-term perspective. So some things are cyclical, like the energy market is cyclical right now. And so long as AI is on its advent, then energy sounds like a great idea. Could we reach a point where we have way too much, where we've overproduced oil and natural gas? Maybe, but I don't see that happening anytime soon. Like oil contracts are just now getting filled and oil production is getting ramped back up. Natural gas is in heavy demand. I don't see that happening anytime soon. So the pipeline carriers of that's a heavy demand thing. But could we reach a point where it's not needed as much? Yeah, maybe. Maybe. Um, DX, I like monthly funds. And I'm okay with the fund. I mean, I bought them. I should be okay with it. We've bought USA, ASG, and ADX. Those are all quarterly payers. I don't necessarily want another quarterly payer, especially one that sits at $15. I mean, ADX is not cheap on its own as it is, um, and I want more of it. I mean, I like the more I look at their portfolio, the more I like it. And quite honestly, the more I like it, the more I like it, and the better I like it compared to USA and ASG because of the overall long-term growth and how the portfolio is built. If I want end-to-end energy outside of ADX, then I have to buy blue chips. right? Meaning the companies that are going to profit from AI. I've got to buy that. And I also have to buy energy and I also have to buy energy transfer. I could buy ADX and buy it all. And if we look at company growth, that's not a cyclical thing. ADX's growth happens regardless of the market. Now they blip like everybody else. It's not a straight scramble all the way up, like all the way up the endless stair. It's not that. It it blips like everybody else. But if you look at it, step back, it grows and they pay a fat dividend. If I want the same output, and I get it, the price point's different, the dividend's different. That's not what I'm talking about. If I want the same overall effect, then I've got to buy a powerhouse blue chip fund, USA or ASG. I've got to piece that together with KYN and maybe NML and get that end-to-end energy and the blue chip aspect. Or I could just buy one fund. So on my end, yeah, USA and ASG are short-term holds. ADX would be a long-term hold. KYN is a short-term hold. How long that short-term lasts or long-term lasts, not short-term in the sense of it's going to be less than a year. KYN is a cyclical thing. USA and ASG, I think, are 20% sale points. And I don't know how that 20% would be. I would love to see it on the growth side of things, right? Sell it for a profit. But at the same time, if they're just paying dividends and the price fluctuates, so be it. Um, I would love USA to gain 15% of value and pay 5% dividends in the next, I don't know how long that would be, 6 to 9 months, but I'm not going to get a dividend until January. ADX, I can buy up until probably the 15th of November and still get the dividend in December. So on my end of things, like this list on you is figuring out what's best for you. This list makes the most sense given the current market, but chances are you can't buy the whole list. So if you want bonds, I would, on my end of things, I would pick the top two and I would not buy DLY. That's not to say it's not a great portfolio, but it's all, we already own BRW and FCO. We can buy them on the dip and get a much better buy-in price. It just makes more sense to me. USA I've talked about, ASG I've talked about, NML and KYN are, yeah, I do. I have outdated data. Um, but they are toll bridge operators, but they also have some other stuff in their portfolio. So it, I think both are great options. DX, you can buy DX. So of the options, I could buy DX for volatility play, knowing the market's going to be volatile. They sell covered calls. You're looking at low points and high points. I get that. I would much rather my end of things not have another category three. Category three meaning quarterly. It pays 3, 6, 9, and 12. So I would much rather have not have another quarterly fund than what we already have. And if you've listened to me, we own three, and I'm kind of looking at selling two of them and just keeping one of them. That's more consistent money, but that's also just, I think, better for me long term. So it's use the current market to my advantage, buy USA and ADX, or buy USA and ASG, and then let the market shift, right? And that price increases and the dividend comes through, and we sell them at a certain price point, and then I roll the money forward into something else versus ADX, I just hold on to. KYN, we've owned, NML, we've owned for a while. We just bought, I think, 100 shares of KYN on the knowing that that's where the market's going to go. And I say that in the sense of that's nobody knows anything. We all hope a lot of things. But if you look at the data and you look at the overall system, AI is eating energy. And the current utility structure in the US and the current energy current structure in the US are both going to have to expand in general. So if AI is really going to be helping, streamlining, making things more efficient, quite honestly upending the existing system, then a lot's going to have to change in order to get natural gas to those data centers to cool off the AI servers to allow all of those things to happen. And that isn't in place yet. And KYN and NML do those things. And KYN, quite honestly, is the slightly better portfolio for that thing. Uh, DX, I could profit off volatility through a quarterly dividend, or I could just buy things when they're low. Um, so DX to me, on my end of things, is not the best deal. Maybe it is on your end of things. Depends on your strategy. But so that leaves this list. So my thought process of buying the next round of stocks was to wait for my dividends to come in for October and then use that with the remaining cash in my account, buy another 100 shares of ADX at whatever price point it was, if it meant the target percentage. And that factors into things too, right? Like if the discount doesn't make sense, I don't want to feel that fear of missing out. It's just to wait and hold and see what happens. Um, but yeah, my thought process was let's hold off on USA because it doesn't pay till January, and let's hold off in ADX because I don't have the funds to buy a straight outright batch of 100, and I kind of like that number. So I would go with that. So we bought well, what you saw what we bought. There we go. But now with the dip and with the rights offering from BRW, that would still put these two funds at the top of my list. And I get everything I've said this session about all these other funds, but those two remain at the top of my list. BRW I like. It is it's shareholder based. It is a shareholder advocate fund doing things in other funds. And I know that because I've gotten a couple emails for other funds we own that BRW does too as well, where they're trying to push for changes. I like that. But it's not portfolio when it can, but it's targeted into bonds, closed-end funds, crypto, minerals, and metals. Um, it's not all this other jazz. And then FCO, yes, it's a bond. It's an all-American, which it has my vote there. It is an all-American corporate bond company that's actually a business development company. Um, and I think both are well placed and well suited for the existing economy and the coming economy. If I was going for a futuristic buy, then yeah, I would buy KYN. And if you wanted just an overall big picture buy, like if you were unconcerned with the existing economy and you were just looking giant overall, like you could advocate for any. Like if you were looking for outright coming economy between the need for pipelines and everything else, that's KYN. But that's also ADX because it's end to end energy and the blue chip companies to go with it. So let if it's me and I'm buying tomorrow, I'm still buying BRW and FCO. I can argue for all of them. If it's me, I'm buying those top two. And if I can figure out this rights things from BRW at 721 a share, that's lower than current value, but that's also lower than my current buy-in value. And I think that's great long term for me. Yeah, I would buy the top two. And if I had the money, honestly, if I had the money for something else, I'd buy them all. Uh, but if I was just looking long term, if I'm playing the short term game, it's USA ASG. And if I'm playing the long term game, I mean, they're all funds we own: BRW, FCO. You could look at the Morningstar reports for NML and KYN and see which one fits your needs better. Then ADX, you get dividends and growth. So I don't want to be wishy washy, but that's how it's gonna play out that way. Because I'm not gonna be like yes, I'm buying this. I'm leaving you with a list and encouraging you to buy based on what your needs are for your portfolio. For me, it's the top two based on our needs and what we have. Going forward, if I don't spend the existing cash, we'll take the existing cash and our October dividends and probably look to buy ADX if it lines up with the overall discount. Like right currently, it the current discount exceeds this discount, so it's a great deal. If it doesn't meet the discount, then it doesn't meet the discount. But yeah, I would pick the top two, but I really do. I have to learn more about BRW's rights offering in the future. Well, I'd love to say yeah, I would pick up that in October, which it is October, so I would pick up that at the beginning of November. Uh, but there's still a lot of time between now and then, so we'll see how that goes. So I do I hate being wishy-washy where it's not a definitive, it's this list, but it kind of is because it's this list, but it needs to be based on your portfolio. It needs to be based on where you feel the need is right now and where you feel the market's heading in the long term. So the advice I could give you, don't chase the obvious, flashiest coin. You want to build a portfolio that, yes, it's diversified, but you want to build a portfolio that optimizes the current market with a long-term perspective. And you want to use the opportunities that just fall at your feet because when the herd panics and they get jittery and the market dips, that is a great time to buy. And we want to use the data to our advantage. We want to use the situation for our advantage because when the herd freaks out, we're not freaking out. We're looking to what's next and we're also looking beyond the horizon. So, whatever you have for the week, I hope it goes well. If you like the content, please consider subscribing, share the video, comment on the video, tell me what you're up to. Uh, and then also just help me get the message out. There is a much better way to invest than buying all these individual funds. Closed-end funds present everybody with an amazing opportunity. I mean, low buy-in, inbuilt diversification, amazing dividends, and growth. So, yeah, if you like the content, consider sharing it to somebody else you know and help somebody else beat the market just like you are. So, whatever you have for the week, I hope it goes well. But ooh, hopefully this didn't pause. My computer just like freaked out big time. So hopefully this doesn't pause bad on your end. But really, whatever you have for the week, I hope it goes well. And I will see y'all on another video. Bye bye.